Welcome you all. The topic for the discussion is monetary policy framework in India. We know that the monetary policy framework in India has undergone radical changes since its introduction or say after the independence. In this section, we are going to explain the major changes or the major phases of the monetary policy in India. What are the changes that has happened in the monetary policy decision making, as well as in the interest, as well as about the rate of the monetary policy instruments in India. Various studies shows that the phases of monetary policy can be divided into 7 phases. That is especially the studies by Deepak Mahandi and Sri Shaktikanta Das have divided the monetary policy changes or monetary policy in India into 7 phases. The initial phase is 1935 to 1949, and second phase starts with 49 to 69. That is, it is in tune with the 5-year plans, or it is known as development years. Then 69 to 85, this period is known as the period for credit planning, or the focus was on credit planning. 85 to 98, the monetary targeting was the objective. 98 to 2015, India adopted multiple indicator approach, and 2013 to 16, it is a stage for the precondition set for inflation targeting, and from 2016 onwards we are focusing on emphasis is on the flexible inflation targeting. This about the different phases of monetary policy in India. That is the initial phase, second one development years, 49 to 69, 69 to 85 period of credit planning, 85 to 98 monetary targeting, 1998 to 2015 multiple indicator approach, 2013 to 2016 preconditions set for inflation targeting, 2016 onwards we are focusing on the flexible inflation targeting. Let us see in detail the major changes that have occurred in each of these periods. The first period, that is 35 to 49, is the initial phase. The preamble to the RBI Act 1934 provided the edifice for the evolution of monetary policy framework. That is, in the RBI Act 1934 has given the rule and the provided details regarding the monetary policy framework. Until independence, the focus was on maintaining sterling parity by regulating the liquidity through open market operation. Up to the independence, our focus was mainly on sterling parity was through the open market operation, or it was regulated by the open market operation. Bank rate and cash reserve ratios are also used for maintaining the sterling parity. That is, during this period we mainly used the open market operation. In addition to that, we used bank rate and cash reserve ratio. In the early years of 1935 to 49, the primary task of monetary policy was to maintain a fixed exchange rate in terms of sterling rupee parity that we have seen earlier, we have discussed earlier. In order to manage the consequent changes in money supply, the RBI was equipped with 3 monetary tools, that is bank rate, open market operation and cash reserve ratio. The RBI announced its first official rate, the bank rate, at 3.5% in July 1935. The first official rate announced by the RBI is about the bank rate. It was 3.5% in July 1935, which was the same rate as was maintained by the Imperial Bank of India. And during this period, the liquidity was enough and inflation was low due to the worldwide depression, and the RBI reduced the bank rate to 3% in November 1935, even though there were strong objections from the part of the government. This was the beginning period, that is 1935 to 49. During this period, our major objective of the monetary policy was to bring parity with the sterling balance, and The major tools used were the open market operation, bank rate and reserve ratios, cash reserve ratio. And India announced its first bank rate on July 1935. The rate was 3.5, but due to the uh, low inflation and enough liquidity position, the RBI reduced the bank rate to 3% in 1935 November. And after that, we could see some of other changes also. The rupee was devalued in September 1949 by 30.5% to meet the rising external imbalances and to match the devaluation of the pound sterling against the US dollar. That is, during 1949, the rupee was devalued. And during this period, the exchange rate between the pound sterling and rupee remained unchanged. In the informative years during 1935 to 49, the bank rate and CRR remained unchanged. The focus of monetary policy was on regulating liquidity system through open market operation. The annual inflation rate showed a considerable volatility in the range of minus 18.4% to 86.7%. And it was severe during the inflation was severe during 1941 and 44 and in 47 and 49 period. This is the some of the important other factors that happened during that period. That is, the rupee was devalued. During this period, the 1435 to 49 CRR remained unchanged. Then inflation was severe during this period, especially 41, 44 and 47, 49 period, and inflation showed a considerable volatility also. And the second phase is 1949 to 69. That is, in the initial phase we have seen that our major objective that was with the introduction of RBI to the independent period up to the independence or after the independence 49. And during this period our major objective was to keep the rupee sterling at a stable rate. The major tool used were open market operation, bank rate and cash reserve ratio. Then bank rate was announced for the first time in 1935. And these were some of the changes that happened, and the rupee was devalued and there was severe inflation, etc. These were some of the important event that happened during 35 to 49. Now let us see what happened during the period 49 to 69. This period is defined as the development year. That is, it is with the 5-year plans. And in the year 1949, the central banking system in India undergone a radical change. Government of India nationalized the Reserve Bank of India on 1st January 1949, and the enactment of Banking Regulation Act 1949 for the sound development of the banking sector. And as per the act, the banks are required to maintain SLR of 20% of their net demand and time liabilities with the Reserve Bank of India in the form of the cash, gold or the abroad securities. This provided a secured source for the government borrowing besides an additional instrument of monetary and liquidity management to the RBI. The monetary policy had to move in sync with the 5-year plans to bridge the resource gap. That is, during this period 49 to 69, in the year 49, the RBI was nationalized. There was enactment of Banking Regulation Act, and as per the act, the bank need to keep a certain the statutory liquidity ratio with the statutory liquidity ratio with RBI, and this provide ample opportunities for the government to borrow, and the resource base of the RBI also increased. And a number of steps were taken by the government to reduce the expenditure and boost food supplies by giving greater emphasis on agriculture in the first 5-year plan. And the bank rate was raised in November 1951. These measures had a sobering effect. Inflation moderated during the first half of 1950s. Starting from the second 5-year plan, the need for supporting plant financing through the accommodation of government deficit by the RBI began to significantly influence the conduct of the monetary policy. And the SLR was raised to 25% of the NDTL of the bank in 1964. That we have seen with the enactment of Banking Regulation Act, the banks are need to keep a push in the SLR with the RBI. It was increased to 25% in 1964. Then the border conflict with China in 1962-63, Pakistan aggression of 1965, then two aggressive droughts in Bihar in 1966-67 accentuated the inflationary pressure. That is, during this period, the due to China border conflicts with China, Pakistan aggression, and drastic drought in Bihar accentuated the or increased the inflationary pressure in the economy. The external imbalance developed with the capital account deficit or balance of payment, and that is a capital account deficit in expanding to 3.7% of GDP in 1966-67. This led to the devaluation of rupee by 36.5% with the US dollar in June 1966. In 1960s, the inflation was considered to be structural and inflation volatility primarily caused by the agriculture failures, so that there was a great reliance on the selective credit control during this period. And that is the second phase is in tune with the 5-year plans, but there was some but Indian economy faced some the extra problem during this period, like the border conflict, Pakistan aggressions, and the drought, etc. And after, as a result of this, the inflation increased, and the rupee was devalued with the US in 1966. And during this period, several selective credit control measures were also introduced. The introduction of several quantitative control measures to contain inflationary pressure while ensuring credit to the preferred sector was also introduced, and the quota slab system, which determined the cost of credit from RBI to the commercial bank, that was replaced by the measures of net liquidity ratio, that is quota slab system. This slab system, which it is to determine the cost of credit from RBI to the commercial bank, was replaced by net liquidity ratio. Besides selective credit control, credit authorization schemes aimed at aligning credit policy more closely with the requirements of the 5-year plans were introduced. Inflation was mostly remained moderate during except 64 to 68. The third period is the period of credit planning, or 69 to 85. During this period, we know that nationalization of major banks in 1969 marked another phase in the monetary and financial policy. And the period 1969 to 85 was characterized by greater social control of credit and fiscal dominance. The focus of monetary policy was on credit planning. And during this period, there was war with Pakistan 1971, and we have faced two droughts in 1973 and 79, and two oil price shocks during this period. There was also a breakdown of Bretton Woods system and of the global exchange rate arrangement in 1973. These developments had severe inflationary consequences, and inflation mounted from 10% in 72-73 to 20% in 73-74 and 25% in 74-75. Due to this unforeseen, or due to these situations, war, drought, and oil prices, inflation rate increased from 10% in 70 to 73 to 25% in 74-75. The 1980 began with elevated inflation and balance of payment crisis, necessitating recourse to a loan of SDR 5 billion from the IMF. During this period, we took a loan of 5 billion SDR loan from the IMF. During this period, we have seen that there was a dominance of fiscal policy over monetary policy. And the system of adult treasury bill, which had begun in 1956 for temporary financial accommodation to the government from RBI, became a dominant instrument of automatic monetization of budgetary deficit. That is, adult treasury bill was accepted as a monetizing tool for the government. To raise resources additionally from the bank, for the government, SLF was progressively increased from statutory minimum of 25% of bank net domestic net deposit and time liability in 1969 to 37% by 9. That is, the SLR was also increased from 25% in 1969 to 37% in 1985. And to neutralize the inflationary effect of deficit financing, CRR was gradually raised. Earlier years, we have seen that bank rate and CRR was raised at a minimal rate, but by 1985 or after 1980, the CRR was also raised from a statutory minimum of 3% to 10% of NTTR. The bank rate also raised from 5% to 10%. And the average inflation during this period rose from to nearly 8.2% per annum. The growth rate is nearly 8.2% per annum. That is, during this period, the credit planning period, SLR increased, CRR increased, and bank rate also raised. The monetary targeting is the next important phase. That is, the focus shifted to inflation management through control of money supply. Till that time, we have seen the credit planning and other focuses of the central authority as well as by the government. But by 1985 to 1985, we started controlling the inflation through the control of money supply, that is the monetary targeting. The monetary targeting framework was based on the recommendation of Chakravarti Committee of 1985. That is better than the credit planning. That is, in order to control the inflation, it is better to depend on money. It is better to depends on money supply control than on the credit planning, was suggested by the Chakravarti Committee in 1985. Under this framework, the reserve money was used as the operating target and broad money as an intermediate target. That is, broad money and reserve money are there, and the reserve money was used as an operating target and broad money as an intermediate target. However, it was not a strict form of constant rate of M3 growth. Monetary targeting was flexible to accommodate changes in real GDP growth. It was an indicative monetary targeting framework with a feedback from real economic activity. This framework provided a nominal anchor in terms of desired rate of growth of M3 for the conduct of monetary policy. That is, the M3 was used as a nominal anchor for the conduct of monetary policy. And a number of money market instruments such as interbank participation certificate, certificates of deposit, commercial papers were introduced based on the recommendation of the Wahal Committee in 1987. In 1985, the government set up the long-term fiscal policy measures. And the fiscal dominance continued in terms of large government borrowing during this period, and statutory preemption of bank resources through CRR SLR had peaked to 53.5% of the bank NDTL by 1990. The microbalance had turned adverse, and the Gulf War of 1990 precipitated the balance of crisis. India had to turn to the IMF for financing. The exchange rate of rupee was adjusted downwards by 18.7% with the dollar. And the BOP crisis of 1991 triggered wide-ranging reform unshackling the Indian economy. Due to all this situation, India adopted the reform measures, or India started the economic reform phase during this period, or due to the development that happened in the Indian economy during this period. And the CRR and SLR was brought down to 9.5% and 25% of the bank NDTL. By the second half of 1990s, the RBI was able to move away from direct instrument to indirect market-based instrument. And during the monetary targeting period, inflation remained in a single digit except for the period 1993 and 94. That is, except 1993 to 1990 to 1993 and 94-95, the inflation remained at a single digit. In the 13 years of monetary targeting period 85 to 98, real GDP increased at a rate of 5.4% per annum. The wholesale price inflation increased by 8% per annum and the consumer price inflation increased by 9% per annum. That is, during this period, the inflation remained. The focus was on monetary targeting and the inflation remained at a single digit. Real GDP increased at a 5.4% per annum. The wholesale price inflation increased by 8%, consumer price inflation increased by 9.1% per annum. Next stage is the stage of multiple indicator, that is from 1998 to 2015. That is from the monetary targeting we focused or we shifted our objective to the multiple indicators. In 97-98, the Indian economy faced the spillover effect of Southeast Asian crisis. The bank rate had to be raised sharply by 200 basis points to 11%. While stability could be restored in the financial market, real GDP growth slowed down. Real GDP growth rate declined. The bank rate was reduced 3 times to 9% by April 1998. From a monetary policy perspective, 97-98 was watershed years as it marked the activation of interest rate as a tool of monetary policy. That is, from 97-98 period, from 97-98 or during 97-98, the interest rate was used as a tool for monetary policy. This was evident from the fact that between April 1997 and April 1998, the bank rate was changed 7 times. Prior to this, bank rate was changed only twice in 1991 in the wake of BOP crisis. On account of measures undertaken during 1990s for developing various segments of financial market, there was a discernible deepening of the financial sector. That is, financial sector started improving. This significantly improved the effectiveness in the transmission of the policy signals through the indirect instruments such as interest rate. Under a conscious liberalization and the growing complexities of monetary management, the Reserve Bank switched to multiple indicator approach in 1998-99. That is, with the liberalization, we focused our approach to multiple indicator approach. Under multiple indicator approach, while broad money M3 continued to remain as an information variable, greater emphasis was placed on rate channels formulating monetary policy. A host of macroeconomic indicators, including interest rate or rate of return in different segments of financial market, along with other indicators on currency credits by the bank and financial institution, fiscal position, trade, capital flow, inflation rate, exchange rate, refinancing transaction, foreign exchange rate available on a high frequency basis were just boxed with the output data for drawing implications for forming. That means we have adopted various measures for forming or framing the monetary policy. In 98-99, despite a variety of domestic and international uncertainties, the economy performed reasonably well. The year also marked the introduction of liquidity management strategy through an active use of fixed rate repo operation. That is, during this period, we used the fixed rate repo operation. The liquidity adjustment facilities with repo action was introduced in June 2000 as an operating aid to manage the liquidity and influence the rate variables. With a view to managing the liquidity pressure emanating from the large and persistent capital flow, sterilization operations were undertaken through the liquidity adjustment mechanism and open market operations, supported by the market stabilization schemes. That is, during this period, the liquidity adjustment facility was introduced in tune with the repo actions. And another important development that happened is during this period is that the Reserve Bank of India in July 2005 set up the Technical Advisory Committee on Monetary Policy, and the Reserve Bank switched to a quarterly announcement of monetary policy while retaining the flexibility to take specific measures as evolving circumstances warrant. The first quarterly review was released in July 2005. That is, during this period, the quarterly announcement of monetary policy was introduced. The Reserve Bank continued taking monetary tightening measures. CRR was increased by 300 points in phase from 6% in March 2007 to 9% by 2008. Repo rate under LAF, liquidity adjustment. The repo rate under LAF was increased in phase by 150 basis point from 7.5% in March 2007 to 9% by July 2008. And during this period, as a response to global crisis, in 2008, the Reserve Bank of India had lowered repo rate by 425 basis point and reverse repo by 275 basis point and CRR by 400 basis point over a period of about 7 months between October 2008 and 2009. And during this period, all these rates were reduced in order to control or in order to face the financial crisis of 2008. In 2009-10, the focus of macro policy shifted from containing contagions of the global crisis to management of recovery. And with a view to imparting transparency to the loan pricing process and improving the assessment of monetary policy transmission and promoting competition in the credit market, the Reserve Bank introduced a new system of base rate for banks in July 2010, which replaced the earlier benchmark prime lending rate system, even as growth reverted to its trend and new challenges. First, the headline inflation accelerated from negative levels in mid-2009 to double digit during the month of March-July in 2010. The year 2010-11 was marked by inflation persistence, with the headline inflation averaging 9.6. That is, we introduced a new base rate system replacing the benchmark prime lending rate, but during this period also the inflation increased. And the Reserve Bank responded to the inflation challenge through calibrated monetary policy normalization. It raised repo rate 7 times during the year by 25 basis points each. Despite this action, inflation remained elevated due to both newer supply side shocks and demand factors. That is, we have seen due to the or after the financial crisis of 2007, the inflation increased, and during this period the repo rate was increased 7 times, and in order to control the inflationary situation in India. The year 2012-13 was marked by slowing growth, lingering inflation, large fiscal and current account gap, and deteriorating asset quality. That is, during this period we faced the lingering inflation, large fiscal and current account gap, deteriorating asset quality, etc. Thus, monetary policy was faced with a Hobson choice. In a longer perspective, during 16-year period of multiple indicator approach 1998 to 2015, GDP increased at a rate of 6.9% per annum, wholesale price inflation 5.6%, and the consumer price inflation 7.1% per annum. And the period of multiple indicator approach also encompassed a period of very high growth and even lower inflation. During the 5-year period, that is 2003 to 2008, GDP growth averaged 8.7% per annum. Next is the period of flexible inflation targeting. That is, after the period of multiple indicator approach, we started flexible inflation targeting from 2015 onwards. That is, we have seen the inflation, though declined, it was at a higher rate. And the RBI moved to review its monetary policy framework with an annual average consumer price inflation touching a double digit for 6 years, establishing credible nominal anchor to retain an inflation anchor. Inflation expectation was important. And the Reserve Bank of India constituted an expert committee to revise and strengthen the monetary policy framework under the chairmanship of Urjit Patel Committee. Following the expert committee's recommendation, Reserve Bank of India adopted a glide path to bring consumer price inflation down to 6% by January 2016. Following an agreement with the government and subsequent amendment to the RBI Act, Flexible inflation targeting framework with consumer price inflation target of 4% with a band of plus or minus 2% was adopted from the financial year 2016. That is, we adopted flexible inflation targeting with a band of plus or minus 2 and with the target of 4% with the financial year 2016-17. And the consumer price inflation declined to 4.9% in 2015-16 and 4.5% in 2016-17. 2013 to 16 is considered as a precondition set for the inflation targeting. That is, the extent of multiple indicator approach was criticized on the ground that a large set of indicators do not provide a clearly defined nominal anchor for monetary policy. And the expert committee was set up by RBI to revise and strengthen the monetary policy, and they suggested ways to make it more transparent and predictable. And in its report in 2014, the committee reviewed the multiple indicator approach and recommended that inflation should be the nominal anchor for the monetary policy framework. That is, instead of depending upon other factors, inflation itself should be the nominal anchor for the monetary policy framework in India. Bringing down inflation in a sequential manner from its peak level of 11.5% in November 2013 to 8% by 2015. And 6% by January 2016 and 5% by the quarter of 2016 was the target. And from 2016 onwards, we introduced the flexible inflation targeting. The monetary policy framework agreement was signed between the Government of India and Reserve Bank of India on February 20, 2015. And flexible inflation targeting was formally adopted with the amendment of RBI Act in May 2016. The role of Reserve Bank in the area of monetary policy has been restated in the Amendment Act as follows. That is, we have introduced a committee agreement known as Monetary Policy Framework Agreement, which was signed between the Government of India and the Reserve Bank of India, and flexible inflation targeting was adopted by amending the RBI Act in May 2016, and the amendment is like this. The primary objective of monetary policy is to maintain price stability while keeping in mind the objective of growth. The RBI adopted a flexible inflation targeting framework under which the primacy is accorded to the objective of price stability defined numerically by a target of 4%. The monetary policy framework in India has also been guided by development theory and international best practices. For example, the collapse of Bretton Woods system of fixed exchange rate and high inflation in many advanced economies during 1970s provided the necessary background to the choice of money supply as nominal anchor. Since the late 1980s, however, experience of many developed countries with monetary targeting framework was not satisfactory. The objective of monetary policy, which called for the adoption of flexible approach to inflation targeting, to achieve macro-financial stability was introduced. The financial stability has emerged as another key consideration for monetary policy, though it is interesting. That is, during this period, the monetary policy in India started targeting the inflation, or the inflation was considered as a nominal anchor for the monetary policy. The evolutions in monetary policy from 1935 onwards are given in this table. It is from the Deepak Mohanty's book, which was published in 2017, about the 8 decades of monetary policy in India. These are the important references used for the study.